Hey everyone, sorry we had a couple of technical issues, but we'll kick off the webinar now. My colleague Afonso is going to share with you a very quick poll. If you could have a look while we're starting, it's just here to assess basically it's here to assess the level of understanding of our participants so that we can then tailor our sessions better in the future. So let me introduce myself. My name is Hélène. I'm CDP's Capital Market and Policy Officer, which means that I'm the person connecting with investors on anything related to EU sustainable finance regulations. I also represent CDP in the EU platform on sustainable finance. For those who are not familiar, it is a working group advising the European Commission on the usability of data in the framework, which, as we will touch on, is particularly important in the context of the taxonomy. So if that's something you also like to discuss, apart from this webinar, I really encourage you to reach out. We're going to try to touch on a lot of topics related to the taxonomy today. The webinar is really meant to satisfy the wide range of audience with different degree of expertise on those topics. So hopefully it will be useful for everyone. But again, if you feel that there's a specific aspect you'd like to discuss in more details, I really encourage you to reach out. You'll be able to submit questions anytime in the chat. Unfortunately, we have started a bit late, so I'll try to do my best to keep some space for Q&A, but in any case, we can also take that offline and answer your questions separately. The event is being recorded. We are going to share the slides and recording afterwards. So in terms of agenda today, we'll start with giving a bit of an overview of the taxonomy, give a bit of a reminder of the background, why it was created, give the basic definition and how it works. Then we'll go over some applications where they appear in reporting, but more importantly, also discuss cases that go beyond disclosures and reporting, and hopefully think about how it can be used for investors and in investment strategies. And finally, we'll touch on data. Of course, we're going to mention the sort of KPIs that we collect at CDP, but the idea here is also to talk about how we can help to interpret this information, how we can show that it's meaningful. And in our opinion, it's really about that to make a real impact and how to utilize that information and engage with companies on the basis of this. So just starting with a bit of an overview and trying to put context around the EU taxonomy. So the taxonomy really fits into the broader EU Sustainable Finance Action Plan that was essentially implemented from 2018 already. It's been evolving since then and it takes different name, but the way you can think about it is that the European Commission really has for objectives to reorient capital flows towards sustainable investments, manage the financial risk that comes from climate change, that comes from nature, resource depletion, and to foster transparency in financial and economic activities. So, in other words, also avoid greenwashing. So it's a very important role that the financial sector has to play in the transition and in the delivery of the Green Deal. There's been a lot of different numbers that estimate the amount of capital needed to finance the transition. It's about public money, but it's a very big part of private capital that also needs to be allocated so that we transition to a net zero economy. So essentially, if we try to summarize what is the EU taxonomy in a nutshell, which is not easy, but you can think about the taxonomy as a classification system that is meant to identify environmentally sustainable economic activities. But it's also economic activity that can really contribute substantially to achieving the climate and environmental objectives that have been set up by the EU that you can see on top of the screen. So there's been 2 for climate change mitigation adaptation, and 4 for what are called the environmental objectives that are around pollution prevention, sustainable water use, biodiversity, circular economy. So what is the purpose of this really? First, as you can imagine, there was not a common language to define and assess what's green and sustainable before the taxonomy, which means that a lot of different interpretation and definition of what's sustainable was, observed in the market, which can lead to greenwashing and low transparency, but just more broadly can be an impediment to really mobilize the financial sector to shift investment towards where it's most needed, and to accelerate the transition. So how does the taxonomy aims to achieve that? Some 2 key concepts that are very important to keep in mind is the difference between economic activities that are eligible to the EU taxonomies and economic activities that are aligned to the EU taxonomy. Eligibility is very, very closely tied to the concept of materiality. So what the EU taxonomy does is to establish this list of economic activities that are eligible by basically selecting the sectors that are the most material for the environmental objectives. So if we take the example of climate change mitigation, the main KPI was GHG emission. So selecting sectors that contribute to the bulk of the emissions, meaning energy, manufacturing, transport, and so on, but also thinking about the sort of activities that can really help substantially contribute to climate change mitigation. So it can be, for example, renewable energy, but it can also be activities that are high emitting activities, but have really a high potential to transition. What is excluded from the list of eligible activities will be typically activities that are considered to always be harmful for the environmental or climate objectives. For example, the generation of energy through coal for climate change mitigation. Now the second step was to define what does it mean to be aligned. So what does it mean to substantially contribute apart from being eligible? And here essentially for an activity to be aligned, it has to satisfy the series of criteria. So first of all, it has to make a substantial contribution to at least one of the 6 climate and environmental objectives that you see on the top. The second, it has to not significantly harm any of the other objectives. And the third part is that it has to satisfy a certain amount of minimum safeguards to be understood as basic human rights principle, tax compliance, and so on from a company perspective. So we're going to spend a bit more time on those concepts to try to bring them to life a little bit. So if we focus on the left-hand side of the screen, thinking about the starting point of this list of eligible activities. As I mentioned, there are different types of activities that can be eligible. So you have the activities that are called to be their own performance. They are eligible just because they contribute. Again, this example of generation of renewable energy would be eligible through their own performance. Then you have the activities that are called enabling. Those are the activities that essentially help other activities to basically substantially contribute to the objective, such as the manufacturing of the technologies that are necessary for renewable energy, for example. And the last category is one that I find very, very important. It's what's called transitional activities. They're important because they're also, let's say, fostering some discussions also, and might cause a problem in the future if they are not apprehended correctly. So a transitional activity is basically a high emitting activity, but where science and technology is available for this activity to emit substantially less carbon emissions. And where it's interesting is that those thresholds are based and put together based on what's available today, right? The technologies and science available today. But this has a vocation to evolve through time. So there's going to be this dynamic aspect of the taxonomy specifically for transitional activities that might today be considered to substantially contribute, for example, to climate change mitigation, but it might not always be the case as time passes and that technology advances or other things change. Once this activity has, passed this criteria for substantial contribution, it needs to assess whether it does not significant harm to any of the other objectives. Here, there are different ways in which a company can assess whether the activity satisfies the do no significant harm criteria. For example, you can look at other types of thresholds. So, for example, GHG emissions thresholds that will be lower for the do no significant harm that they are for the substantial contribution. There are also process-based measures, such as making sure that mitigation has been implemented for this specific activity. Or the do no significant harm can also refer to international standards or EU legislation. So making sure that the activity is in line with the current EU legislation regarding pollution, regarding biodiversity, water use, and so on. And it's important to keep that in mind because it highlights that it's not a straightforward and simple exercise. It is subject to interpretation, and it can also potentially be a problem when it comes to the international application of the EU taxonomy, where typically a company that has activities outside of the EU or a non-EU company might not always be able to assess whether their activities satisfy the do no significant harm principle. And finally, once this activity has passed that criteria, then at the company level, the company needs to assess whether they are satisfying those minimum safeguards. The last part that I'd like to highlight on this slide is focusing on the right-hand side. What is very, very important to remember is that a non-eligible activity does not mean that it's a harmful or unsustainable activity. And it ties back to the fact that the taxonomy was really focusing on what is material and what makes a substantial impact for the different climate and environmental objectives. So typically what's going to be out of scope are the low environmental impact activities. They will not be part of the list of even eligible activities. Additionally, there are certain activities that are material for climate change, but they still need to be assessed. So as you can imagine, it takes a lot of time to kind of define and come up with all those different technical screening criteria. So there are some activities that are still yet to be included into the list of eligible activities. And it is very important to keep in mind, and we'll discuss that in the data part of the presentation as well. It's because of this dynamism into the taxonomy, it can be hard to compare year on year, but also we need to make sure that the lack of eligibility isn't necessarily interpreted as being harmful for the environment or not being sustainable. So I'm going to try to just bring that a bit more to life with an example. So if we think about the one economic activity, that is the manufacturing of cement under the climate change mitigation objective. So on the left-hand side of the screen, why is this activity eligible? So it's eligible because of its materiality. So cement manufacturing is material for climate change based on the volume of GHG emissions. It is typically an example of transitional activities. So technology and science is available to make it greener and reduce substantially the emissions that are coming from manufacturing of cement. On the right-hand side, what are the sort of criterias that the manufacturing of cement needs to fulfill in order to go from eligible to aligned. So the first one is the criteria, the threshold that needs to be attained so that it makes a substantial contribution with a 1.5 degree world. I've put one example. There's a series of criteria for this particular activity, but one of them would be that grey cement clinker needs to have specific GHG emissions that are lower than 0.722 tons of CO2 per tons of grey cement clinker. This number is not coming out of nowhere. It's actually very tied to the emission trading system of the EU and how the quantitative thresholds are measured to allocate the emission trading. And essentially, the way it's calculated is by looking at the manufacturing of cement out there, looking at how much GHG emissions they emit, taking the 10% of the best possible cases, and essentially setting the threshold to be able to say that it's achievable is just the 10 best cases that reach that threshold. The nuance with this is that, as I mentioned earlier, it's meant to evolve, right? Currently, this threshold is based on the ETS quantitative threshold that have observed data from 2016, 2017. So essentially, as time passes and that manufacturers of cement improve, this threshold will dynamically be updated. When it comes to the do no significant harm to other objectives, typically the manufacturer of cement has to make sure that it satisfies general criteria for the other environmental objective. I'm going to give you an example with climate change adaptation. The manufacturer of cement will need to demonstrate that it has ran a climate risk and vulnerability assessment to make sure that its activity is not subject to substantial physical climate risk, for example. And finally, the minimum safeguard, in other words, is to ensure alignment with OECD guidelines for multinational enterprises and UN guiding principles on business and human rights. So hopefully that gives a bit more of a tangible kind of explanation of how the taxonomy works. Now, if we think about the application in practice when it comes to a reporting standpoint, but also we'll try to move the conversation a bit further into how does it tie back to the broader sustainable finance framework and sustainable investments. So since the taxonomy has been introduced 2020 and then 2021 for the technical screening criteria, it's also been influenced and referenced across the board of the regulatory framework. So typically it amended SFDR when it comes to product level disclosure. So making sure that taxonomy is also part of the product level disclosure of funds. And very importantly, maybe the core part of it is that it got plugged into the requirements for reporting at entity level in the EU. So related to the Non Financial Reporting Directive that now is going to be replaced by the Corporate Sustainability Reporting Directive, where companies need to report at their entity level when it comes to EU Taxonomy-alignment and eligibility. But it also was plugged in other parts of the different regulatory framework. It was introduced as part of MiFID sustainability preferences, and very recently with the political agreement of the green bond standards. The taxonomy is a very big part into making sure and assessing that a bond can be considered as a green bond standard under this EU framework. So now just thinking a bit about the timeline here and thinking in particular about which companies will have to report on their taxonomy. So a lot of those regulations have happened sort of simultaneously or in various orders, but essentially the way you can think about it is that there's been a phasing in approach that's been used to make sure that basically companies will have the time to prepare and report little by little on those different pieces of regulation. So typically, in 2022, you already had a subset of companies that had to report on their taxonomy eligibility. And from 2023, you can expect data coming in when it comes to the taxonomy alignment, again, on a subset of companies. But this will increase through time as you have this phasing in approach of more and more companies that will have to report on the taxonomy. So we're not going to go through into details on all the different thresholds applied here, but essentially who will have or who has to report on their EU taxonomy. So you can think about it in summary as any large EU companies, whether they are listed or private. You will have listed SMEs as well, and you will have a subset of non-EU companies when they are generating a substantial part of their activity in the EU, whether it's through subsidiaries or branches. And it's important because the CSRD has a much broader scope than what you currently can expect under the scope of the NFRD, which is what you will get in 2023 in terms of taxonomy alignment. So in a nutshell, NFRD, you can expect basically large listed European companies. And why does it matter in the context of investors? So of course, investors really need the data from their underlying companies in order to make their own assessment and make their own reporting. So this also was taken into account somehow by introducing a difference between which companies, notably in 2023 or in 2024, have to report on taxonomy alignment. So a year has been given to financial corporates to report compared to the non-financial corporates. So basically this year, any financial corporates will only have to report on their eligibility. And in 2024, financial corporates will need to start reporting on their taxonomy alignment. So it's a year later than for the non-financial corporates. Now, the issue is that financial institutions also invest in financial institutions. And additionally, a large part of investments can be in companies that will only need to publish later on, like SMEs, for example. And even then, if we look at the future 2029, a lot of non-EU companies fall outside of the scope and won't have to publish on their EU taxonomy at all. So that brings up the discussion around what type of information can be used for those exposures, either by encouraging adoption outside of scope, which kind of relates back to the point of the international operability of the taxonomy, whether a non-EU company can actually measure their taxonomy alignment, or to think about what can be used as equivalent or estimated data. I'll be brief on this, but this is just to highlight that different stakeholders, so different types of companies will need to report slightly different type of information for their taxonomy. And this is because not the same KPIs are relevant for all types of organizations. So typically non-financial corporates will have to report on the percentage of revenue, CapEx, OpEx that are taxonomy eligible and aligned. But it's not necessarily the right KPIs for banks, for example, that will rather have to report on a green asset ratio. Similarly, for insurance companies that have non-life underwriting, they'll have to report on percentage of premiums that are taxonomy eligible and aligned. But something that is worth noting is that there are still some asset classes for which no methodology has been developed yet to really measure alignment to the taxonomy. So typically government bonds need to be excluded from the nominator and the denominator of disclosures for financial institutions. Similarly, for the companies that don't fall under the scope of NFRD or CSRD, they should be excluded from the nominator. So even if they provide information voluntarily. And this can be problematic because what we really want is to encourage the adoption by smaller companies, non-EU companies, and try to avoid negative effect of focusing only companies that fall under the scope or for which we have data. The general guidance given by regulator is that for those corporate level reporting, estimates should not be used. It can be used under certain conditions and be disclosed separately, but in general, estimates shouldn't be used for now, as of now. Which brings us to a slightly different angle because it's different for the type of disclosures for taxonomy at the product level when we talk about the application of taxonomy within SFDR. Here, the products that fall under SFDR and that make sustainability claims, so in other words, Article 8 and 9 products, have to disclose on their taxonomy alignment and not eligibility, actually, just alignment. And it's an important distinction. So typically, you'll have to specify whether you're making any sustainable investments that are defined using the EU taxonomy, specify what minimum share or in EU taxonomy-aligned activities, whether you invest in taxonomy-aligned gas and nuclear, provide portfolio breakdowns, provide also this distinction between enabling and transitional activities. And even Article 9 or 8 products that do not intend to make taxonomy-aligned investments should still report on taxonomy alignment through the periodic reporting as well. So there's really this element of tracking the percentage of EU taxonomy-aligned investments in funds through time. And similarly for nuclear and gas, similarly for enabling and transitional activities. So how does that relate to the concept of sustainable investments? So SFDR gives a definition of sustainable investments as an economic activity that contributes to an environmental objective, as measured, for example, by key KPIs that are like the use of energy, renewable energy, raw materials, impact on biodiversity, and so on. So sustainable investment in an economic activity that contributes to an environmental objective is different from the taxonomy-defined environmentally sustainable activity. And that brings us to a slightly different definition of sustainable investment that has been observed in the market, that is either happening at the activity level of a company, looking at the company's green revenues, for example, compared to company level KPIs. So rather assess a company practices and environmental characteristics to assess whether these companies can be considered a sustainable investment. In theory, little by little, the taxonomy should be used to assess green revenues. So rather the definition of sustainable investment in terms of activity level and revenue level. But we can think about the use of taxonomy as well, playing a role into assessing a company level KPI and practices. And here what I mean is that, for example, the taxonomy KPIs that are CapEx based and more forward looking typically will refer to a company investing in their transformation regarding, for example, greening their energy consumption or making their buildings more energy efficient. And it relates to the overall performance of the company, right? It relates to their scope 1 and 2 emissions. So for now, realistically, we don't have enough step back from the data, but the idea is that as it will come through and that we'll have a better understanding of what those numbers mean, it can really fit through and inform as well the consideration of sustainable investments, specifically in financial product. The last thing I'll mention is how is it possible that a sustainable investment is not an environmentally sustainable activity. So here again, we go back to the concept that sustainable investment could be defined as an investment in an activity that has a low environmental impact, and that typically is not part of the scope of the taxonomy now, that really focuses on the most material sectors and activities. It could be also the case that the activities are not covered yet by the EU taxonomy. It could be the case that the sustainable investment is focusing on social objectives, and we don't have a social taxonomy yet. So this is all to say that those two concepts are separate, and there are reasons for why they are separate, but we should be thinking about how we can leverage this tool that is the taxonomy to also start informing sustainable investment. There are also a lot of discussions around the application of the taxonomy in transition finance. So because the taxonomy is based on financial KPIs, so we've talked about it, percentage of revenue, CapEx, OpEx, it tends to be suited for corporate transition planning, which a transition plan, in order to be realistic or credible, needs to have several criteria, including having a clear intention of dedicated budget and money spending by a company to implement their transition plan. And this is really explicitly referred to in the regulation at corporate level disclosure. It is mentioned that companies should include part of a plan to expand their taxonomy-aligned activities, or to turn the ones that are eligible and not yet aligned into aligned. It can be about revenues, it can be about CapEx or OpEx. So for example, when companies don't have a lot of their activities that are eligible under the taxonomy, they can still make some spending or capital expenditure that are taxonomy aligned. So for example, they can purchase more renewable energy, and that should count as a taxonomy aligned activity. This is where the transition finance really has a role to play, whether it's in investment strategies for asset manager, or more direct financing through bank lending, or specialized lending in particular, in order to have the means to fund a specific initiative from a company to either increase their green revenues or transform their production process to become more energy efficient. So right now, if we think about the type of financial instrument that exist, the green bonds, typically the green bond standards are one of them, but there are other instruments that are emerging where the taxonomy can little by little play a part into making sure that investors have a way to associate their investment to the transition of a company. There is conversation also around whether we can introduce the EU taxonomy in climate benchmark. The issue here is that we need to be careful when doing this about, again, having this step back from the data and understanding what does it mean to have a lot of taxonomy alignment, or what is not a lot of taxonomy alignment. It's going to depend on sectors, activities, and additionally, referring back to this transitional type of activities where the criteria will be reviewed little by little based on available technology. That means that a transitional activity that is aligned today might not be in 3 years' time. So it's really to spur discussion on how to use taxonomy the best way possible, and also the need to think about what those numbers really mean. And finally, it's also important to keep in mind how to make sure this can also help the just transition. So how can we make sure that this also helps funding smaller companies, or that we're able to apply it at the international level, and in particular to direct funding towards developing countries, or at least to not shift that capital away from places that actually need it. So that brings to the question of how do we get this data from companies or from different counterparties. So here we're gonna try to go more into the data side of things. I don't think I need to reiterate that we have a data gap and challenges when it comes to really having a full picture of the investment universe when it comes to making investment decisions. But I'll just touch on what we've done this year to really try to accelerate the implementation of sustainable finance taxonomies at scale at CDP. So essentially, we've introduced in our questionnaire a taxonomy agnostic question, first of all. So this was meant for the purpose of allowing non-EU companies that might have different taxonomies in their own jurisdiction to also report on their own taxonomies. However, we've done a lot of work to provide guidance and almost of a step-by-step thinking to companies choosing to report under the EU taxonomy when it comes to their spending and revenue. So all of the KPIs that we mentioned so far in the presentation will be captured in our data. So eligibility alignment, per economic activity level, whether it's transitional on performance, whether it meets the do no significant harm criteria, minimum safeguards, and so on and so on. But we've also added additional qualitative questions because we thought it was important also for the company to describe the methodologies, for example, that they use to identify how they met the technical screening criteria, explain how they met the do no significant harm criteria, etc. And we also introduced the question around the verification and insurance of the data, and a question around the taxonomy alignment plan to really focus on the forward-looking aspect and whether the company has made plans to increase that alignment. So there's going to be more and more data coming through for investors, but what we think is most important, as highlighted throughout the presentation, is really to put context around the data and make sure that it fits into the overall company's action. So we have explicitly integrated that question into the transition planning section of our questionnaire. So we were already asking about transition planning and the spending and revenue aligned with that transition planning in the past. And the idea here is really to encourage the company to go through a step-by-step assessment of their transition plan. So it's essentially first asking, do you even have a transition plan? Then it's asking about whether you have a target associated with it. And then it's about assessing whether you're linking your financials to it and whether it's taxonomy aligned or not is almost, a step in the journey. So it's really about making a journey out of it. And we work a lot with companies on this. The scope applies to public, private, small, etc. And the aim is to encourage and capture also early adoption by those companies. Which leads me to my point around engagement. So it's very important to collect the data and to have the data, but it's also very important to engage with companies in particular when it comes to that data. It can be engagement for disclosure, but it can be also engagement for impact. So we launched a program this year called the Green Finance Accelerator, where we partnered with investors to really work with companies to disclose, measure their taxonomy, but provide them support to do that, and ultimately to try to foster conversation with investors to use that data in a meaningful way. So going back really to the point of how can we make sure that that data can be compared, trusted, and that it can be tracked through time in order to foster the use of transition finance. So it's a pilot. Right now, everyone is more or less focusing on disclosures, mandatory reporting, but the purpose is ultimately that it's used in investment decision making. And for that, we really believe that there's a need for a facilitation between of conversation between companies and investors. And maybe I'll finish with a bit of an illustration with numbers, what I mean by putting taxonomy data into context. So typically, based on 2022 data, we can see that a certain number of companies already identified their products and services as low carbon using the EU taxonomy. The biggest category was around power, road, building construction and renovation. But that doesn't mean that they integrated the taxonomy yet into their transition planning. So typically we had approximately 200 companies that mention using the taxonomy to identify their spending and revenue aligned with 1.5 degree world. And that compares to approximately 1,000 companies that disclosed that they identified spending revenues aligned with 1.5 degree. And that compares to approximately 4,000 companies that disclosed even having a transition plan that is aligned with 1.5 degree. So it's about also thinking about how we can even encourage companies having a transition plan to then think about how we can use taxonomy KPIs to link that to their spending and revenues. Out of those 200 companies that mentioned the taxonomy in their spending revenue, interestingly, there was a few that were non-EU, approximately 30, including UK, US, Brazil, China, and it was a mix between non-EU companies adopting the EU taxonomy. It was mainly UK companies, but there were other cases. Or it could be non-EU companies that are subsidiaries of EU companies. And it can also be non-EU companies that are a very large group and which securities are being traded on EU-regulated stock markets, in which case they would fall under CSRD and might have to disclose on their taxonomy. So in other words, there's, again, an interest in kind of thinking about the different use cases and how different stakeholders are apprehending the EU taxonomy. Finally, there are more to come. So we've been focusing on the 2 climate objectives of climate change mitigation adaptation, for which the taxonomy technical screening criteria have been published. But the 4 remaining objectives, notably around biodiversity, nature, in general, have been also are expected to be adopted in the near future. The consultation is already closed. There was a consultation on the technical screening criteria for those objectives. And if it was to be implemented, at least so far in the draft, it would mean that companies would have to disclose on their eligibility for those 4 environmental objectives starting in 2024, covering the year 2023, which is very, very short-term news. And in 2025 for alignment. This is not finalized yet because there's been the consultation, but at least that's the timeline that has been announced. Additionally, from next year, the Commission will review whether we can include exposure to governments and central banks in nominator and denominator, and whether we can include also the smaller companies and non-EU companies that are out of scope of the NFRD and CSRD, but that provide voluntary information. And finally, and I'll stop there and open for Q&A, like I mentioned, this is an evolving framework. So we can expect the list of activities included to grow over time. And additionally, keep in mind that regular review of the screening criteria for the transitional activities that is supposed to happen every 3 years, but nothing prevents for it to happen as any new thing emerge. New technologies, and updates in scientific estimations. So I will stop there. We started late, but we still have time for a few questions at least. So maybe, unfortunately, I cannot see if there were any questions. So Afonso, maybe if you're on the line.
Yes,
thank you.
Give you a hand. We have a first question, which is about basically economic activities, and it's, does life insurance underwriting in this context also refer to health insurance underwriting? I don't know if you would.
So can you repeat whether life insurance is also a non-life insurance?
If it also refers to health insurance underwriting.
So I'm not an insurance specialist, I have to admit, but my understanding is that life insurance would rather refer to investment products. So I don't think health insurance would classify as life insurance. It would rather fall under the scope of non-life underwritings. But that's typically the type of very nuanced applications that are also being discussed at the level of the EU platform on sustainable finance. That typically for complex insurance companies, there's been issues into applying part of the taxonomy because of the complexity of the different activities. So I'm also happy to have a more extensive conversation on that because it's very, very technical. Maybe, offline.
Okay, in terms of other questions, the audience has been quite shy, but we have a few hands up. So if you're willing to take oral questions.
Yeah, absolutely. But I have to admit, I'm not sure how to mute people, or they can unmute themselves.
I can do that.
Okay. Yeah.
So we have Pierre. Pierre can go first, I hope.
Yes, thank you very much. It was super useful. On the slides about SFDR ratio and what would apply to a financial institution, you said derivatives are not considered in the ratio. I thought it's not always the case for PAIs, for instance. I'm not completely sure, but I think it's a bit more complex. And I'm curious, just to make the case, let's suppose that in the fund we decide to leverage and to maybe use a total return swap to take a very big position on a green stock. That would not be considered anything that would increase the greenness of the fund, although we're taking much more risk and we support with our capital, those economic activities much more using derivatives. I'm a bit curious what you think of that.
Yeah, no, that's a very good question. And actually, the use of derivatives is also one of those, you both are touching on very specific and difficult points that are being discussed right now at the level of the working groups in the EU, because as you mentioned, they are not straightforward to apprehend, right? So there's been experts that are brought in regarding derivatives, and I mean, again, not an expert on derivatives, but I know there are a lot of different types of derivatives that can relate to physical assets or not, and so on. So there is ongoing work to define further how derivatives can fit within that framework. So totally agreed with you. It's not set in stone or black or white. There are different use cases, but that's what makes it so complex to regulate, essentially. Here, what I've put on this slide around the exclusion of derivative, it is particularly linked to the entity level disclosure on taxonomy alignment and eligibility. So it is not, it does not refer to the fund level applications, which is here again how we do ensure coherence between the frameworks. But derivative is one point where it's been clarified that you shouldn't be using exclusion of derivative in the denominator of what the entity level, so at the asset manager level, for example, will report in terms of their taxonomy alignment. Now for the PAIs, it's even something different. So here I'm just talking about taxonomy. PAIs, there's not been kind of an explicit regulation around it that's been amended, but essentially there's been guidance that has been provided by the ESRS that derivatives in the context of PAIs could potentially be included in the denominator as well, in order to, but using specific techniques for netting positions. So here again, I can refer you to those documents in particular, but the exclusion of derivative on that slide refers exactly to the EU taxonomy reporting at entity level.
Thank you.
So that.
Great. Next, we have a question from Niels. So I'm gonna hopefully Niels can unmute.
Okay, can you hear me now?
Yes.
Yeah.
Perfect. Thank you very much. Thank you for a very, very good introduction to the taxonomy. I realize it's a complex issue, but I found this easy to follow. Nils Holta, I work at EcoHertz. I have a sort of highly technical question that I'm hoping maybe you can shed some light on. I see in a lot of the, especially the climate mitigation criteria, there is a demand for final product to have lower than such and such life cycle CO2 emissions. For example, aluminium, hydrogen. But I'm a bit unclear on how companies can prove that. So I think my twofold question is, how can they prove it? And if it's talk about using electricity or other forms of energy, can they use guarantees of origin to prove that they've used renewable or low carbon energy? Thank you.
Yeah, no, that's also an excellent point. And I think that is meant to be addressed by making the taxonomy reporting subject to insurance and review by third parties. So there's also essentially this notion that it's incredibly difficult for a company to assess themselves essentially the alignment of their taxonomy, not out of bad faith, but because those are very complex metrics to measure. And typically the details of what do you include in life cycle assessment, I also, on the slide I've showed here, when it comes to low carbon product and services, I also captured that, we have a question on what was the methodology used by companies to assess that. And of course, you have a very large amount of dispersion in the methodologies that are being used. Even life cycle assessment, you can use cradle to gate, end of life stage, use stage, etc. So I think it's a very important concept. It's gonna fall under the responsibility of a company to estimate what's material for their particular product. And then whether we can trust that data or not is really gonna come down to trying to get as much insurance as possible with third party verifying that information afterwards. That's at least the direction of travel when it comes to dealing with the uncertainty in the data.
Thank you.
We have some trouble hearing you, Niels. The microphone didn't really.
Oh, sorry. I was just saying my list to follow up with that.
Yeah.
So does this mean that it's not clear whether or not any portion will be used under taxonomy?
Yeah, I'm happy to follow up on that and take that offline as well. We couldn't hear you clearly, but yeah, please reach out to me.
Okay, next we would have a question from Francis. You should be able to unmute yourself.
And thank you so much, Helen, for the presentation. Very helpful. So I have a question. It's a bit of a clarifying question for asset managers, right? So how is this whole reporting or disclosure on the taxonomy? So I see the SFDR 2019 RTS and then the MiFID, right? Is there any interconnection between these? And then what are the implications for asset managers that are domiciled outside of the EU? So say in London.
Yeah, absolutely. So essentially the taxonomy, as you pointed out, is a tool that kind of amended a few regulations, right? So the way you can think about it is that for those asset managers that fall under the scope of SFDR right now, so there might be non-EU asset managers, but are marketing and selling funds in the EU, for example, you'll have to comply with the SFDR requirements. So typically under that condition, the reporting of the taxonomy at the fund level will apply to the funds that you manage that are covered by SFDR. Now for the entity level, so this corporate disclosure of a bank, an asset manager, that are non-EU, so the taxonomy reporting at the corporate level will happen only if your organization falls under the current Non-Financial Reporting Directive or will fall under the Corporate Sustainability Reporting Directive. So it's two different applications. One is at fund level, and when it comes to at the entity level, essentially you can think about if you fall under one of those categories, that you have a subsidiary, for example, in the EU, it might have to report the EU taxonomy at the subsidiary level. But if you don't, then it's only way later on that you might be considered as a non-EU company that generates a lot of their activities in the EU, for example, and in which case you might start falling under the scope of reporting EU taxonomy at the entity level. And it's worth for anything, including MiFID. Basically, if your funds or your activities currently fall under those regulations, you can think about the EU taxonomy regulation as having amended those. So, it's basically if your funds fall under SFDR, they will need to also fulfill the taxonomy reporting requirements.
I see. Thank you so much. Thank you so much.
I think we are on time.
That is all the questions. So.
Okay, great. Well, thank you so much for, maybe Alfonso, if you can give the last poll, if for those who are still on the line, people might be leaving now, but
yes, thanks for
we're just gonna for those who have 2 seconds to spare to say if you learn something, then that would be useful for us to assess whether we need to readjust our
Is it possible to get
sessions.
a slide? Sorry.
Yes, absolutely. We'll share recording. Hopefully, recording has started given our little tech issues at the beginning. But the recording, at least the slide, will be shared afterwards. And again, I appreciate the very technical questions. I myself working a lot on those topics, so wasn't trying to push them aside, but they require extensive discussion because it's not a clear answer that can be given. So I really encourage people who have those questions to reach out separately. I'm very happy to discuss this. Okay. Well, thank you all very much for your time. Thank you, Afonso, and have a very nice afternoon. Bye.
Thank you.
Bye-bye.